All right, let's get right into it. PayPal. I mean, pretty much everyone's heard of it, right? Most of us have probably used it. But what's really fascinating is the story happening behind the scenes. A story that's, well, it's a bit of a paradox.
And that brings us to the big question we're tackling today. You've got this absolute giant of a company, pulling in over $32 billion in revenue, and it's profitable. But then you look at its stock, and it's a completely different story. So what's the deal? How can both of those things be true?
And yeah, this number really says it all. Over the past year, the stock is down more than 27%. That's a huge hit for a company this big. It's the very definition of a paradox. So to figure out what's really going on, we have to look under the hood.
Okay, first things first. Let's talk about PayPal's financial engine. Because before we get into the problems, you have to understand that this company is built on a really solid foundation of financial strength.
Now check this out, 9 out of 9. What is that? Well, it's something called a Piotrowski score. Think of it like a financial report card with 9 boxes to check for good health. PayPal gets a perfect score, and 9 out of 9. That's just exceptional, and it tells us the company's run incredibly efficiently.
And you can see that strength right here in the numbers. Just look at this revenue growth. It's not a fluke, it's consistent. We go from $27.5 billion to almost 30 to nearly $33 billion today. The main business is still growing, plain and simple.
And that revenue isn't just for show. This is the key part. PayPal is wildly profitable. We're talking $13.7 billion in gross profit, almost $5 billion in pure net income. The company is a cash-generating machine. And that right there is what makes the stock's performance so confusing.
So, if the foundation is so strong, where's the problem? Well, this is where the story turns. Because despite all that strength, there's a storm that's been gathering on the horizon, and investors are definitely taking notice. This right here gets to the absolute heart of the issue. See, PayPal's main thing, that branded blue button you see everywhere, it's growing at about 8%, which, sounds decent. But here's the catch. It's actually growing slower than the rest of the e-commerce world. And when you're the leader, falling behind the market is a huge red flag.
And a big reason for that slowdown? The competition is absolutely brutal. PayPal is basically fighting a war on 2 fronts. You've got the tech titans, Apple and Google, muscling in with their own payment systems, and then you have these super agile fintech companies like Stripe and Block's Cash App just chipping away at their market share. And to top it all off, you've got forces outside of their control. People are just spending a little less money right now, and that hurts. And then you see this. 15 different analysts have lowered their expectations for the company's future earnings. When that many experts start getting nervous, Wall Street pays attention.
So, what's PayPal's plan? Are they just going to sit there and take it? No way. This brings us to their next chapter, a big, strategic countermove that they hope will not only fight back against these headwinds, but totally reinvent the company.
The leadership team is betting big on what they're calling 3 generational shifts. First, making their digital wallets even better. Second, diving deeper into the whole buy now, pay later trend. And third, and this is the really futuristic one, is agentic commerce. Basically, think of it as AI-powered shopping, where your personal AI assistant does all the work for you.
And what's so interesting is that parts of this new strategy are already working, and working really well. Both their buy now, pay later business and, of course, Venmo are growing at more than 20% a year. So these aren't just ideas on a whiteboard, they're already becoming serious growth engines.
And that third bet, agentic commerce, this quote from Bank of America just puts it all into perspective. They think this could be a $1 trillion market. That's trillion with a T. By teaming up with companies like OpenAI, PayPal is trying to plant its flag right in the middle of this next massive shift in how we shop. So, when you put it all together, you get this classic Wall Street showdown. It's the bulls versus the bears, the optimists versus the skeptics. Let's break down exactly what each side is arguing.
Okay, so the bulls, the optimists, they see a company that's making a brilliant pivot. They're looking at the future of AI commerce, they see the crazy growth in Venmo and BNPL, and they love that the company is giving cash back to its shareholders. But the bears, the skeptics, they're focused on right now. They see the core business slowing down, the brutal competition on a stock that's just been a huge disappointment.
Which brings us to the final $58 billion question, because that's about what PayPal is worth today. After looking at everything, the good and the bad, what is next for PayPal? For the people who believe in the turnaround, the potential reward is huge.
This number represents what Wall Street analysts, on average, think the stock could be worth. A potential 60% jump from where it is now, if, and that is a really big if, their big strategic bets actually pay off.
So in the end, it really all boils down to this one question. Is PayPal's big bet on the future, on things like AI and new ways to pay, going to be enough to fight off all that competition and get its old magic back? That's the